This is a video about backtesting. So mainly for beginners, you should know that backtesting is just a process of scrolling back in the charts in history for you to see how your trading strategy would have performed, and also so that you can try to know the average risk reward that your trading strategy can have. And it is compulsory for you to backtest any strategy and any instrument that you shall trade before you even start trading it, even on a demo account. That way you will even have better trading psychology, so that you will make unnecessary losses and unnecessary fear for losses. And also, for when trading on a real account, we backtest so that obviously you will only trade things which are profitable. And also, when backtesting, now remember that for me, I use exponential moving averages to determine higher time frame trends. So if you are going to use them also, since the ones that I gave you try to follow institutional order flow well, make sure that for the daily time frame, before using them, you would have loaded at least 3 to 6 months of trading data on the daily of time frame. And then if it's the 4-hour time frame, just try to make sure that you would have scrolled back. Even now when trading going forward, you should now have at least scrolled back even at least 3 or 4 pages, okay, for them to be able to calculate past price data determined by the 9 and 18 moving day exponential averages. Then for weekly time frame trend, where you use now the period 18 and period 40 exponential moving averages, even also including for the monthly time frame trends, try to make sure that you have at least 1 year trading data or more for the weekly time frame. Then for the monthly time frame, maybe even more, maybe like 2 years or more, so that they will also be able to calculate the calculations well. And you can always go on the internet if you want to find out how the calculations are done, but you don't have to necessarily remember them. The indicators are already there for free. Now, in case if you are someone who's just new to my YouTube channels, for the moving averages, you just from the beginning you would have come to your indicators icon on the top of the chart there, then functions for you to add another one, and then moving average. So if I would now to type the 40 exponential moving average, it's just 40 there. Then for all the exponential moving average, they should be on exponential instead of simple, which will be the default. They will come at simple, then apply to will be close, and then you can select whatever color you want, and then you would then select save for it to be added. Then for you to delete them, you go back and then you select on the bin icon there, then select the one you want, then click on the bin icon again, and then they will be removed. And then when recording trades, if you want to know the take profit of a trade, let's say it was a sell trade where price was declining there, to note the amount of points it went down with, you select the crosshair, okay, you move it to where you want to start, okay, with one finger, then you keep pressing on the screen with one finger, and then you now press on the screen with the second finger, and as you drag the second finger, you can now see the measurements being written on the screen. So the first one will be the number of candles, and then the second one will be the points, which we will use to determine your take profit or even the stop loss. So that will be 14.7 based on the numbers of these exchange rates and the decimal commas they use. And you can even then use them for stop loss measurements. Then if you want to place a red vertical line, you can always come to your lines so that maybe you can pull your crosshair from different price levels, and then if you double click on it, it will no longer have the black circle, which shows that you can be moving them. Like if I double click there, right there, I can move them, and then if I am to double click them again, it can no longer be moved, and you can see the black circle will be there, and it can make it easier for you to pull from it if you that would have been your entry point and you would want to pull to see your take profit and also your stop loss in the opposite direction. Now, when backtesting, you may also see that maybe it might be faster and easier for you to backtest using a computer instead of a phone. Although you can still backtest using your phone well. And when backtesting using your phone, remember that your phone shows fewer candles. So when looking for trade setups, especially for PDRAs like order blocks, I can use this zoom level, which is the starting from the biggest one, you scroll in once, twice, and then second. Okay, and then maybe I can then place a line to know where price would have been maybe at an order block, and then maybe I'll then scroll back to come and see if price had ever reached there. But you can always later on zoom in better so that you get better readings of the exchange rates, or also for you to drag your crosshair to see your take profits and stop losses. And also you can even record better if you even zoom into the biggest zoom level. That way now it will be able to show even a more accurate record of your take profit or your stop loss. And now remember that it's not all strategies which you have to pull into this small zoom level to look for setups. For some of them you won't have any problem, like for the other strategies which you won't be using PDRAs. When you are recording your trades for backtest, make sure that you are recording them somewhere where you don't lose the records, where later in the future you can come back in case maybe you get more knowledge and other ideas for you to come and develop your strategy so that it can even have better returns. And it also might help in that you might be lucky that that strategy maybe in the future could give you an idea for you to be able to blend it with another strategy. Okay, so also make sure now when you are recording your trades that when recording the trades, write down the date and also maybe the time of the trade for intraday trades, so that when you are recording your trades, in case you make a mistake in recording your trade, you will be able to come back to the trades and come back into the charts. So you try to see which trade you might have made a mistake, in case later on you will discover that maybe you were using the wrong conversion for time zones or any other form of mistake. Now also in backtesting, remember that I told you that your trades should have, for when you are doing intraday trading, which are trades which last within a day and usually not longer to exceed the next day, your backtests should last for at least 1 year or more, with at least also 20 trades or more. Now, even though on the 20 trades, if all of the trades have a good percentage win rate, which I recommend you to have 70% win rate or more, or 65% if you are desperate on strategies which are hard to get good win rates, like the weekly or monthly range binary option strategies for predicting weekly or monthly bias. When you are checking your trades now, if you were looking for 70% success rate, even though if the trades or the 20 trades have 70% win rate, but then they don't have good risk reward, meaning that the wins are not the same distance as of the stop loss or drawdown, then you can look to check the trades which have another extra market condition, which for example can now be adding also to include the 4-hour time frame trend in the same direction, when maybe the original trades did not necessarily have to have the 4-hour time frame trend as compulsory in the same direction. So now when adding the 4-hour time frame trend confirmation or confluence, if they will obviously now be less trades, which now could be maybe instead of 20 could now be about 15, or worst case scenario 10 trades. If on that maybe now 15 trades, that is when you will start to have a 70% or a good risk reward, okay, of at least 1:1 or more. You can even use those 15 trades to determine that trading with the 4-hour time frame trend is now profitable, even though they won't be 20 trades when using the 4-hour time frame trend. There will no longer be need for you to demand to have 20 trades with the 4-hour time frame trend and to now record and add other trades, because remember, your 20 trades, we having compulsory only the daily time frame trend, would have already had 70% win rate. So you no longer need to demand 70% win rate on 20 trades, when now the 4-hour time frame is also now included, and now having to backtest and record another 5 trades. You shall see later on with experience that all those other extra market conditions improve the performance of your trades. So they all obviously would have had the same win rate or more. But on that back test, maybe you will see that on the 15 trades, if there will be a win rate for the trades including 4-hour time frame, which will be less than 70% win rate, it does not necessarily mean that adding the 4-hour time frame trend has reduced the performance of the strategy, but it may be just that there will now be a losing streak, where there will be a slightly less performance than usual. But were you to record more trades, you would see that over maybe 30-40 trades or more, the win rate will obviously go above when you were trading only with the daily time frame trend. And you also even probably saw that in the PDF for synthetic indices that I gave you on the backtest results for V10 ones, I also did the same. But if you are patient enough, you can record the other extra 5 trades in such a case to see to make sure that you would have 70% win rate or more, but it won't be necessary. So on the backtest results, that is there on page 38. Okay, so these were for V10 one synthetic index. On these ones were for pairing of order strategy. Okay, or of those, and you can see that before considering separate trading conditions, it was a 24 out of 27, but you can then see that now when including risk reward to the trades, I was no longer making sure that there will be 20 trades because they already had a good performance win rate on the full year on at least 20 trades or more. But now when including these market conditions which give good risk reward of at least 1:1 or better, the trades would have been less, but it won't be much of a problem. Even you can see here for the order blocks, it would now be 5 trades now, including only the market conditions which give risk reward of 1:1 or better, even though I would have already seen a good win rate when before considering the risk to reward. But if you want to be highly accurate, you can always continue to add your trades to make sure that you have at least 20 trades, but it won't be necessary because you will see that with experience, all those other market conditions which I showed you, they already improve the performance of your trading. So even though you will see a less performance after adding some of those confirmations or confluences, in other words, you only have had a less performance in terms of win rate only because sometimes it would have been a losing streak. But later on, after adding many trades, you would have had better performance. So for length of backtest, remember I said for intraday trading, it has to be at least 1 year or more, and at least also including 20 trades or more. Then when trading stocks intraday, your backtest should now have at least 2 years data or more, but also still with at least 20 trades or more. And the reason why I want you to use 2 years at least for trading stocks or equities intraday, because stocks have less volume and they are considered as gambling with some mentors. Not because the trading methods which I gave you don't respond to them, but just because of the lower volume that they have compared to other asset classes. But you can actually trade them profitably, and there are actually other profitable traders who actually even make a living from also trading stocks. Even if you go on the world trading competitions websites, you can also even see some people who would used to trade the stocks or equity divisions. For beginners, remember stocks are like your Facebook, your companies like not MetaTrader, but Meta, the one which owns Facebook, even also for Apple. So for stocks, you probably will see them in the other previous competitions. Looks like the most recent ones are not showing the ones for Forex, but if you check on the competition side, you actually see that there are also those who would trade for stocks or equities. Okay, so you can actually see this one with 122% interest on a year in 2009. And you can always check for the others later on, even on other websites which have different world trading competitions. Now, when you are day trading the other instruments, of course, I said at least a year or more. But now, if you are going to do short-term or swing trading, where your trades in short-term trading last for more than a day to about a week, and in swing-term trading they last for more than a week to about 2 weeks or up to a month, you are obviously going to need to record your backtest for longer periods of time. So for the usual asset classes which are safer, like Forex and stock indices, and both their CFD and future versions, for me myself, I just record for at least 20 trades or more if they have, as long as they are just more than a year on the backtest. And then for other riskier asset classes like stocks, if you want to do short-term or term trading on them, just record them for periods which will be longer than what you would usually do on the safer asset classes. So even for the other riskier asset classes which have more manipulation, like gold and maybe the other metals and cryptocurrencies, and also for those with low liquidity and the newer emerging markets like ETFs, if you are someone who loves them and really want to trade them, also make sure that you backtest them for longer periods than what I recommend for the usual safer assets like Forex and stock indices with better liquidity and volume. Then if you are obviously going to short-term and swing-term trade, or even if you are going to do position-term trading of a few months or more on the riskier assets, obviously you are also going to want to record them for longer periods of time. So usually 20 trades on short-term trading of predicting the weekly bias, where you trade within that week, can have about 4 years. So probably you are going to have almost about 4 to 6 to about 8 years, depending on the short-term strategy for the safer instruments. So you will maybe just record double that time period if you are going to record the other riskier asset classes, so that you try to compensate for the added risk and also try to record in other periods of times where there were different fundamentals affecting the asset classes. Now, when backtesting, also try to avoid to use backtesting softwares which you will see being promoted on the internet, unless if the trading strategy is one which can be programmed well into the backtesting software. So for those who are still new, backtesting softwares are just programs which can backtest for you and record the trades for you, and even show you in more detailed display even your risk to reward, even also your profit factor and other things. But the disadvantage with using backtesting softwares is that it's very rare for you to find or to be able to have a program which can have a trading method which is consistently profitable. Okay, nearly all the people who sell or provide any form of trading methods which can be decoded in a software, nearly all of them are not profitable, except maybe usually for those used with hedge funds or other trading firms which use quantitative trading instead of our qualitative trading, which we use mostly charts here in retail trading. If you are going to use your software to backtest, make sure that it is able to include everything that is within your trading strategy. Now, also when backtesting, when using repainting indicators, like especially the oscillating type of indicators like the MACDs and the RSI, those indicators, you should know that they do not accurately show what price did in the past history. When you scroll back with strategies of oscillating indicators, you may actually see as if your strategy has a 80 or 90% win rate. But you will see that when testing now or trading going forward, you will have a losing strategy because they only now paint the end result after price would have moved. But when trading, you will see that even if you were to sell when the RSI is at an overbought level, if price when the reading on the RSI reaches the overbought level, and price now moves in your favor direction on the chart now going down, if price on the chart will now increase even higher, price on the RSI may continue still to be at that overbought level, which may be 80, but now it will not continue to go sometimes to 100 or 90 level on the RSI reading, even though on the chart price will still be increasing. So you may actually have problems. So if you want to use oscillating indicators, maybe you can only use them for confirmation, but you must have backtest results which already will be profitable without you using the readings from the oscillating indicator or any type of indicators which changes its reading too much. But if you are just using the moving averages for trend on higher time frames, you usually won't have these problems, especially the ones which I gave you. And I actually never had much problems, as I would actually see that those exponential moving averages would improve performance in my trading and also even in the back test. And if you want to read more information on the repainting of indicators, you can just research that on the internet. There's more information there. And then when recording your backtest now, wherever you record them, always remember I said to keep the copies somewhere in case you want to use them in the future, in the case that you may think of an idea for you to improve your strategy. So if you are recording it on print, on hard copy, in a book, just make sure that you keep your book somewhere safe. And then if you are recording them electronically, always make sure to back up your files just in case something happens to your device, be it with a virus or anything, or you lose your device. And now when recording your backtest, you don't have to necessarily write full sentences of the market conditions which your trades had. So you can actually even use abbreviations. Okay, for example, for actually it will take me longer if I go there. It might even be better if I just type them here. So for example, for 4-hour time frame trend, okay, you can just even type even 4-hour like that. Okay, even for 4-hour, even if you want to use the daily time frame swing, you can just use any form of abbreviations which you can remember for yourself. You can even use some of the ones which I had in the backtests for the synthetic index PDF, but I think I tried to use full words so that some people may not be confused. But even for the first protraction of day, you can just use just PR. But now when you are now writing down a summary of the trade instructions you shall use after doing the backtest, that is maybe when you can now use proper words if you want. But you don't have to necessarily use full sentences when recording your trades, when still recording the trades for the backtest, because that will just take more space for your hard copy trades in your books, which might actually be unnecessary, and it will actually be more of a strain on your eyes when now counting the trades which have certain market conditions. You will see that it will be easier for you if you had just used abbreviations, because they are easier to spot and see, and you can use whatever abbreviations make you remember the trades better. And then also keep records of your trades, like I was saying, with the date of each trade, and for scalp trades, also for the times of the trades. And then if you are going to use the trading model which I gave you for determining your risk by using the maximum consecutive losing trades, which your strategy can do based on the average number of trades it can do and the performance win rate, so you can risk higher and get better profits. You definitely now on such trading will have to record also the time of each trade, when the profitable trade would have begun to when you had your biggest TP, or when you had the take profit that you will later determine to use at the end of your back test, which will even be a better reading. But for losing trades, I will just record the time which I would have opened the trade. Then now remember, when backtesting, for you to determine a trade to be profitable, it should have a risk reward of at least 1:1 or better, meaning that the take profit or the maximum profit achieved should be at least the same distance as the drawdown before the maximum take profit was achieved. And then for the losing trades, those are just your trades which would have failed to have at least 1:1 risk reward or better. And when recording now, make sure that your backtest at the beginning will be labeled the instrument and also the time frame which you are recording, and also maybe the market conditions which you are recording, so that in the future, if you were to look back and look for that backtest result, you will be able to find it easily. Now, after recording all your trades and counting your percentage success rate and looking at your market conditions which respond to certain different take profit and stop loss levels, also look to see if your strategy has certain weaknesses, and sometimes you can even observe some of these weaknesses or strengths even while still recording the trades. Like, for example, certain strategies which may be recorded on very small time frames, like the 1 minute time frame, or other time frames, like even for people who trade boom and crash synthetic indices. You may want to make sure that you enter your trades early enough when trading such trades now when you are now trading. And you may also sometimes even observe that if it's trading of those very small time frames, you should make sure that the spread of your instrument will be able to still allow you to have almost 1:1 risk reward or more, especially for financial instruments which usually have bigger spreads, especially for the asset classes with instruments which are less traded, like NFTs, the newer emerging markets, or even in other asset classes. But now, when looking at exotic currency pairs in Forex or minor cap stocks in stocks or equities, some of those instruments may have bigger spreads. So you will also have to check even to see if your trades can usually be filled for strategies which are traded on very small time frames. Because some strategies, even those which may not be traded on very small time frames, but even on 5-minute time frame, you may have certain strategies where price can quickly move in your direction or favor, and you might not be able to get your entry filled by the time maybe you would have calculated your stop loss and your take profit. So for such strategies where you will miss out on some of the good trades to a significant level, you may have to add one more extra confirmation, or to add one more extra market condition or sentiment which will try to compensate for some of those winning trades which you might miss on. And also some other weaknesses which some trading strategies may have will be if they are a bit subjective. So if they are a bit subjective, like order blocks strategies, they are PDRA strategies which maybe sometimes price might return to an order block which you can see on your chart, which may even be 3 or 10 days backwards in history. So you might also want to add one extra market condition or confirmation to try and compensate for those missing trades which you won't know the take profit and stop loss levels, or even the performance win rate which happened there. Other weaknesses which may happen in certain strategies will be if you are trading stocks or equities. Remember that even though the US stock market opens from 9:30 to 4 p.m. EST, if you want to trade soon as the market opens, it might be hard for you to open a trade within the first 3 minutes of the market open of the regular market hours from 9:30 a.m. to 9:33 a.m. because of the rush of volatility of many orders from the institutions. there might be a lot of slippage within those 3 minutes. So you might not want to open trades within that time, even though some of your profitable trades might be there. So those are some of the things that you may also want to look out for, and maybe even other things that I have not mentioned here, where maybe a specific strategy might have a certain weakness or strength. And remember that some strategies, if they don't have more than 1:1 risk reward, you might not want to trade them when trading synthetic indices from derivative, unless if you are going to add another extra market condition which improves your performance. Because remember, I told you that you must have good sentiment when trading derivative synthetic indices to try and compensate for the weak regulation, and also the booking, conflict of interest, and also derivative only being the broker which has the price source of the synthetic indices. So if they are 1:1 risk reward trades, I just add 2 extra market conditions which improve my performance. But if they are trades with more than 1:1 risk reward, I only then just add 1 market condition or confirmation, since the extra reward to risk will also improve my performance. But if you are in financial instruments, at least we have brokers with good regulation, which are access.com and FXView, which are tier 2 level regulated. So on those brokers, and even if you can find another broker with better regulation, if you are outside of Zimbabwe, you won't necessarily have to add any sentiment to compensate for manipulation of trades. Although for strategies which are a bit subjective, like order blocks, where you can't see return to order blocks which formed even 10 days ago, you may just want to add 1 extra confirmation or market condition. Because remember that the markets move by algorithms which may work even with things which we are not able to see in the charts. So for beginners, remember that benefits of backtesting also are to increase confidence in your trading. Whenever you are having losing trades, or you are in a losing streak, which is just a period with many losing trades, always just remember that in your backtest, your trading strategy would have been profitable. Which is why also it's good to backtest and record your trades for a good period of time, where intraday it will be at least a year or more, with at least 20 trades for the instruments with good liquidity, and then more periods, longer periods for those with less volume and liquidity. And then also you should know and have more confidence that when you are backtesting, you are doing a risk-free assessment of knowing whether your trading strategy is profitable or not. So that's also another advantage of backtesting. And backtesting also has the advantage of you being able to do a fast assessment of your strategy's performance. Because to trade the strategy going forward on a demo account would obviously need you to trade for the strategy at least for a year or more for intraday trading. But with backtesting, you can just evaluate the performance even within a few days up to a week, depending on the instrument and depending on how much hours you are able to backtest per day. Then when backtesting, you should also know that if you are trading CFD versions of instruments for any asset class, be either stocks, forex, or anything else, that the wicks of the brokers will be different from different brokers, even though the bodies of the candles will always be the same. So for those who are still new, remember, wicks of candles are these needles, and the bodies will be the thicker regions. These will be the bodies. So they will be the same on CFD versions of instruments across all brokers, or maybe just with very minute differences, but nearly the same, but the wicks may actually be significantly different. So make sure that when backtesting CFDs, you record on top of your backtest results the name of the broker that you are using, and that you will only use those backtest results only to trade on that broker. This is why it's also important, if you are to use someone else's signal, for you to know the broker which they are using. And then if you are aggressive and still want to use someone else's signals, or if you want to use your backtest results from one broker to another broker, then maybe you can just add maybe another extra market condition or confirmation which improves performance of your trading. So you will have less trades, obviously, but more safety. Then if you are trading futures versions of instruments for any asset class, the prices will be the same, so you won't have a problem in regards to that. Now in trading, also make sure that your trading strategy and also trading method are based on logic. Okay, don't just take strategies like, for example, where people are just using indicators and just saying, I'll open a buy trade if there is a crossover of this moving average and this moving average, using it as a signal on lower time frames to open trades, or to just say, I'm just going to sell and open a sell trade if my MACD indicator or stochastics indicator gets to an overbought level. Those strategies will not have long-term consistency, even though if they will respond for a certain period of time. Even also strategies including support and resistance on lower time frames, although it may respond well on higher time frames like the daily and higher. But even for others, trading strategies which are not profitable, like candlestick patterns and supply and demand, also don't use trading strategies like those, which the logic cannot even explain the reasons in which price should actually move in your favored direction. Okay, your trading strategies should be based on price action of why and how the markets move. Okay, not because for example, the moving average crossed another moving average on the 1 minute time frame and you are already now taking a trade there. You have to trade trading strategies and even trading methods which have logic, which makes sense. That way you will be able to have long-term consistency for you to be able to actually make a living through trading. So also try to also avoid other things using other people with other people like VWAP or even also order books. And I actually gave you a list of all the trading methods which are not profitable in the video with trading scams on my YouTube channel. so you can always check them there. Then in trading, also now trade, it's recommended for you to trade trading strategies with a win rate of 70% success rate or more in terms of counting winning trades versus losing trades. This will give you an advantage that even if for trading financial instruments, certain world events may happen which affect the market, your win rate will still lower to a good win rate where you can still be profitable, be it 65% or even 60% in worst case scenario. And even though you can still trade a trading strategy which has even at least 55% win rate or more after covering your trading costs, it is still good to have a trading strategy with a high win rate of 70% win rate or more, because it also enables you to cater for any errors which may be in your backtesting. Just in case maybe there are some errors in technical analysis, since we do not have 100% guarantee that using a take profit level of the smallest take profits in your backtest will always be observed, and we also don't have exactly 100% guarantee that using a stop loss level of the biggest drawdown on all your profitable trades will be respected when trading on 100% of your trades. So it will also be able to cater for some of those smaller errors, and also even for those strategies with little subjectivity like the order blocks, where we don't know if price may return to another order block which occurred even 5 days ago, which we are not paying attention to the charts. And also, it will also even be able to cater for the other smaller errors which could still occur, like I mentioned earlier in the video, in case if the number of trades that you will use to determine risk reward on your backtest will have less than 20 trades, even though the 20 trades would have had a good percentage win rate on all the trades, but would have not have had a good risk reward on all the trades, but only have a good risk reward after adding an extra market condition which improves your trade performance. So for maybe time frames or certain strategies which are hard to get 70% win rate, like maybe if you are to predict maybe weekly bias and to use it as a confirmation in your trading, you can then be more flexible there to use even at least 65% win rate or more. And then if you are in countries which are outside of Zimbabwe and you are lucky to have a binary option broker like Ducascopy and Nadex with good regulation, tier 1 level, and if you are lucky for them to offer very high payouts for binary options like close to 98% or better, you can also even there, if you are aggressive, trade even instruments which respond with about 65% win rate or more on your backtest, because at least you will only lose about almost 1% from your success rate if it's a 90% payout. Since for trading synthetic indices on binary options, synthetic indices also sometimes on certain days may have very high payouts, like almost 98%. If you are someone who's aggressive, you can also maybe trade some synthetic indices if they have a 65% win rate or more. But some of the times they will offer you maybe 95%, 93% payout, just meaning that for every amount you put at risk on the trade, they only pay you a profit of 95% of it or 93% of it if you win trade. But try at best to trade only instruments with at least 70% success rate or more on your strategy. Then also in trading, also avoid trading strategies which are very subjective. By subjective, I mean things which are hard to define, where you and the mentor who taught you, if you are told to look for trade examples within a given time period, you will not be able to point at the same examples that he or she would point. So other examples of trading strategies which can be very subjective are like the head and shoulders pattern retail strategy. Okay, a lot of people will be pointing at different examples. So trading such strategies will have a problem because when you are backtesting and recording your trades, you are going to miss out on some trades even that other people would be considering as trades that you should have recorded. Although order block strategies do not fit in this category, it's just a bit subjective, and you can compensate either with trades which have more than 1:1 reward to risk ratio, or just one extra market condition in case if the risk reward ratio which responded on that instrument will be 1:1. Now, also when recording your backtest, you can even just before you start your backtest, just look to see the size of the spread of your instrument, especially for trading on very small time frames, and especially if you are trading financial instruments. You will see that certain instruments like stock indices of Aussie 200 index or JP 225 index can have very big spreads. And also when trading some exotic currency pairs in forex asset class, or I'm not sure in stocks for small cap stocks, if there will also be big spreads. After finishing your backtest, even if you didn't check before, but after finishing your backtest, just check to see if the instrument has a very big spread, because some of them you can even clearly see that the spread will be very big to the point that your instrument may no longer be able to be traded with a good risk reward. Also remember that if you are trading with FX View broker, they have very big costs for trading their stocks, their equities. Companies like Meta, Facebook, even BMW. So you actually won't be able to trade some of the scalping strategies or even some of the day trading strategies on some of the stocks in FX View. So if you are a Zimbabwean, you can then trade such stocks in XS broker, even though xs.com will now be B booking instead of FX View, which is A booking. But it still will be okay since XS has tier 2 level regulation, which is still safe. But definitely, even if you would have not paid very precise attention to the spreads of instruments which might have slightly bigger spreads after the backtest, always make sure that you check before you open your trade. Now when trading, in case if the instruments will have a significantly bigger spread which can affect your trades, especially the trades for very small time frames. If you are trading with a broker which charges commissions on commission-based accounts instead of spread accounts, when trading, you are going to have patience in knowing that there are some instruments which, even though they were profitable in your backtest, you are not going to be able to trade them because the trading commissions might be higher and you might not be able to trade them. Now, also, you must know that there are certain major world events which can also affect backtest results within the charts, like the time when there was the COVID pandemic. You might also want to avoid backtesting in your charts that area because of the fear which would have been in the markets at that time, and with large institutions pulling their money out of the market, there would have had been less volume, and also performance of your trading would have been less. So you might also want to avoid trading that time. Then also related to that, there are also, remember, fundamentals which affect your trading. Fundamentals, remember, these are just economic or world events, if you are still new in trading, which the events affect also the markets in which you are trading in. So when trading, I advise you not to trade December and January months, as they will have lower volume, as institutions might have gone to the holidays. But if you are going to be aggressive and trade, then maybe just trade only including the first week of December and maybe the last 2 weeks of January. But you will see that the whole of December and also February will have less performance compared to other months. Now also remember when backtesting that and also that December and January months on the previous point, they only affect financial instruments, but not synthetic indices from derivative, like the volatility indices, the jump indices, and others. These fundamentals and even also the world events on the previous topic, it's only for financial instruments like forex, stocks, even also metals and others. Now also in fundamentals, for financial instruments, your trading for July and August will also have less performance compared to other months. If you are going to trade in July and August months, make sure that when you finish your backtest on recording your trades, check to see if the trades of July and August will not make your risk reward of trades to be worse, or even if they will reduce the success rate of the instrument to the point where you can't trade it. If they do, try to count again your win rate whilst not including the trades of July and August months. And August will actually be a bit worse compared to July. So if you are patient enough and if you have backtests which involve maybe at least a few years or more for intraday trading, you can even check to see if you can even have a slightly better risk reward in your July months, whilst including the July months and not including the August months. And then also other times which have performance which is less than usual is the whole week of NFP weeks. Remember, NFP will be the week with the first Friday of each month in nearly all cases, although there will be rare occasions when that could change, but you can always search for that on the internet, since it will be public knowledge. And even though if you do want to trade in the NFP week, if you are aggressive, just make sure that you trade up until the Wednesday's morning session in New York EST time. But you will never trade from afternoon of the Wednesday to the Friday of the NFP week, as there will be more manipulation in the markets. Now, other fundamentals, like I told you in the video for fundamentals on the YouTube channel, for fundamentals like CPI, PPI, and even Fed chair speech events, I don't necessarily include them or take note of them when recording my backtests, although I will just avoid the red folder high impact events of such events when I will now be trading. But if you are patient enough, if you have a lot of time, you can always go on forexfactory.com website or investing.com website for all financial instrument asset classes. And then for stocks or equities only, and maybe sometimes stock indices, on FinViz website, you can check for the earnings event, which occur 4 times a year, and see if they won't affect your trades. That is, if you have the free time for you to be able to do that. But for me, I just don't pay attention to them. But now I will just avoid trading them when now trading forward. And then if I will get free time, then that is when I will scroll back on those websites with news events to see if I can improve risk reward of my trades without the CPI, the PPI, the Fed chair speech events, and the earnings for the stocks and stock indices maybe in particular. And you can scroll back in history on those websites. I'm not sure with FinViz, but with forexfactory.com, I'm actually sure you can scroll back in history. Now, for the tools in backtesting, I already showed you these in the beginning of the video, where you can use your crosshair and drag it to see the number of points which your trade would have had in profit or loss, or even using the horizontal lines, or even other tools you can use, even rectangles, where on a higher time frame, okay, you can even, if you are maybe on the daily time frame and you are trading within a daily time frame order block, performance could maybe improve for trades on lower time frames within it. So if you come to your shapes, to your rectangles, and on a higher time frame, if you draw the shape, you can even edit it after long pressing it. Select on the pen and then even select on fill, so a color will be put inside, and maybe you may want to select a lighter color so that you will still be able to see your candles. And you can obviously choose whatever color you want on the style there, and then select save on the top right corner there. And now when going on smaller time frames, your rectangle will still appear. If it won't appear, you just go to your settings still, long press it, okay, go to the settings, and then make sure that it will be selected for you to be for the color to be transparent even on smaller time frames. You can see here it's written time frames all. So just in case it wouldn't have been selected there, you would just have to make sure that it will be there. And you can obviously even search for tutorials on the internet for how to use TradingView application if you are going to use TradingView application, which may have more tools which are better than on MetaTrader. And for MetaTrader, the computer, the desktop version, you can also search for tutorials there on how to use them, which you can also have better functions than those here on the phone. And you can also even try to see if you can use other functions here on the mobile MetaTrader on the phone, which I have not mentioned, which may be on other tutorials. But I think I already showed you most of the important ones. So if you have questions on backtesting, you can just ask me.